everybody. My name's Allison, and I'm the Director of Risk Tolerance here at Simpler Trading. And in today's video, I want to talk with you guys about SPX. Now, overall, this has been a pretty choppy market for the year. In regards to a bigger picture point of view, the market has not really been able to break 4,200 as a strong price resistance level, and that's currently right where weekly resistance is at with the 100-period simple moving average. And at the same time, on the bottom end of things, we have not broken below 3,800, which has been our main price support for the year. We've just been chopping in between those two levels. We had a run up at the start of the year into 4,200. We stalled. We reversed back down into 3,800 to test those lows again. That held. We bounced back up. And now we're back around the 4,200 range. And you can see since then, we've just been in pure consolidation, especially this past week or week and a half, where we've been holding really 4,150 as price resistance and 4,100 as price support. Now, if you guys are like myself and you like to be a bit more of a trending trader and jump into calls and puts and play for the moves up and down, this is a very difficult market to do that in because we're not getting those strong directional moves. We're not getting that volatility. We are remaining flat. And so today I want to share with you a trade idea that benefits from consolidation and benefits from the choppy narrative, and that is an iron fly. So an iron fly basically consists of a call credit spread. In this case, we'll look at a 25-point with credit spread, and it consists of a put credit spread. And both the short strikes on the call and put credit spread share the same short strikes. As you can see, they're within the same expiration and they're the same spread width, and that is what creates an iron fly. And so I think an iron fly is really beneficial in this market, especially if you're looking at more from an intraday perspective, or even if you're looking at it for a weekly perspective, like I'm highlighting here in this trade idea. And that's because it can benefit from not having those directional moves. It can benefit from chop, just allowing the theta decay to work off the premium that you receive on the trade idea. And so in this case, for Friday's expiration, which is 3 days out, I would be looking at something like this, as long as, of course, it's within your risk tolerance. And let's walk through that. So this is an iron fly where our wings are at 4,150 as resistance and 4,100 as support. That's right in line with the short-term support and resistance level I mentioned here that we've been trading in the majority of this week, right? 4,150 is kind of the top end of the range. It's really where we bounced up and stalled at back on May 3rd. But more recently, you can see that was the high on May 5th, and then we've been chopping in that range ever since. 4,100, on top of it being a psychological level, is the support level we've held since breaking above it back on the 5th. You can see that we went down and tested that range on the 10th, it held. We went down and tested that range back on Friday on the 12th, it held. And so the idea is that for the remainder of this week, we won't really see a strong break to the upside. We won't see a strong break to the downside. We'll overall continue to consolidate. If that happens, then the theta decay should work out rather nicely on this trade idea, especially if we stay within the middle of the range, which is 4,125, right? That's right where we can see that short strike is at. And so right now for this trade idea with Friday's expiration with a 25-point with spread, you're looking at about a $20 credit and about a $5 risk. Certainly not a bad risk versus reward parameter. Once again, you have to be okay with the $5 risk, but if you are, this could make a great strategy to just sit on and wait a bit going closer into market close to benefit from the overall chop and consolidation. It matches with the momentum resetting. It matches with the consolidating signal in the compound breakout tool. It matches with the overall flat Bollinger Bands. Our moving averages are right around that range. The 10-period simple is at 41.19. The 30 period simple is at 41.22. So it's right by those moving averages as support and resistance, right? In regards to, depending on what side we're trading on in the price, that's right by where we placed our short strike. And of course, 41.25 is a psychological level. And when we look at open interest, it has a decent amount of open interest for this being the middle of the range that we've been stuck in for a while. So I certainly like this trade idea. And even though it seems a little bit more boring, right, compared to a directional move where you get a strong bounce up or a strong bounce down, it's the strategy that, at least as of right now, is currently matching the market environment, which is overall consolidation. Now, if this is a little bit outside your risk tolerance, but you like the trade idea, you could, of course, look to bring in your short strike sum, kind of narrow the spread. For example, if we take it from a 25-point spread and reduce it down to a 20-point spread, it does mean you have a little bit of risk on your long strikes because they're not placed nicely at support and resistance at this point, but it does reduce your risk by quite a bit. So instead of having a $5 risk, you're now looking at a $3.20 risk. And on the flip side, it does also reduce your profit potential sum. Instead of having a $20 profit potential, you're looking at about a $16.90 profit potential. Still not a bad risk versus reward to take advantage of the consolidation. If you're concerned, Powell is technically speaking Friday. So if you're concerned he could move the market, which I personally, not to say that he can't, right? We've certainly seen last year where as soon as he opens his mouth, it feels like the market moves. But the reason why I'm not anticipating it as much for this week is because we recently had the Fed Day, right? Where he not only talked about the rate hike that they're doing, but he talked about potential future moves of the Fed. He had the press conference. And though we did have a beautiful daily range around that announcement, we didn't actually trade outside of the chop and this overall general chop that we've been in off of the news, right? We couldn't get a stronger trending move to occur like we saw last year. And so if we couldn't get one off of the actual event that day, I'm not anticipating him to cause a strong market reaction on Friday. Now, of course, he always could, which is why first and foremost, we need to be within a capital risk environment that we're comfortable with, that we're technically okay losing 100% on, right? You want to stay within your risk tolerance. But if you're like me and you're of the thought process that it's not really going to be that dramatic of a market move to get us out of the current range, then this is a good strategy to consider to still allow yourself a decent profit potential while keeping your risk lower and having a strategy that matches the current market environment. If you are a little concerned about that, you could, of course, look to bring this in a few expirations, right? So instead of doing maybe Friday's expiration, you could always consider doing tomorrow's expiration. Here, if you do a 20-point width spread, it's about a $15 credit, $4.90 risk. You only have today into tomorrow to worry about it, so you don't have to sit through the Fed news or unemployment data or anything like that. And you can still allow the theta decay to really work in your favor. As long as we remain chopping in this range like we have been, then theta decay could really work out nicely. Once again, if you want to narrow the spread sum to make for a better risk versus reward, you could look at a 15-point spread. That's about a 12.30, 12.20 profit potential versus a 2.80 risk. Excellent risk versus reward parameters. And you don't necessarily have to hold this into the close for cash settlement. As long as we get theta decay that happens today into tomorrow, you might find yourself closing out of this a little bit earlier in the day and scalping the quick win while protecting the capital risk on the other side of things. So I think doing things like iron flies, or you might also consider something like an iron condor, right? That's another way to go about it. You could get closer to your support and resistance levels here. If you do 41.40 and 41.05 as your two short strikes, you give the underlying price a lot more room to move in between. And as long as it stays in between 41.05, 41.40, right, both of these spreads should expire worthless. It does limit your profit potential. You can see it's dropped down quite dramatically to about a 270 credit, but it still only has about a 230 risk. And like I said, gives you a much wider range to allow for that max profit potential versus an iron fly where you're really looking for it to pin if you're trying to aim for that max profit overall. And so those are the trade ideas I'd lean for. Now, like I mentioned, if you're more a directional trader like I am at heart, or you like to trade more off of the intraday charts, trading options in this market is hard, right? To maybe meet your daily profit target that you have for your account each day. But one way to still go about trading it is actually looking at the future side of things. For those of you unfamiliar with futures, right, I'm right in that boat. It's something that I'm starting to learn myself and add to my toolbox of trading tools to work with. But futures can still allow for some really great profits in this market environment. Now, you need to be mindful of the risk that is around